Hello. The company being analyzed today is Solarworld Energy Solutions Limited. This is a company which is looking to double its revenue in fiscal year 2026. Since in 1 year, it is aiming to double its revenue. So today, we're going to analyze the company's financials, what it does, and its future outlook. So let us start. First, we have the market cap. Market cap 2,607 crores. So pretty small cap company. Current price of one share 301 rupees. The price to earnings ratio of 29.9, almost 30. Really nice return on capital employed 40% and return on equity 40%. Let's move on to the profit and loss statement. Heavier profit and loss from 2022 all the way to 2025. We have sales, we have operating profit. Pay attention to operating profit margin. We have profit before tax, and finally, the last black number, the net profit. So, in fiscal year 2022, company had sales of 28 crores. Okay, then massive jump up. In 2024, the company had revenues of 501 crores, and finally, in 2025, companies had revenue of 545 crores, operating profit of 107 crores. Okay, and finally, a net profit of 77 crores. So you can see there has been a massive jump. In percentages terms, the revenues has grown by 170% CAGR over the last 3 years. Last 12 months, though, the sales has slowed down to 9%. Very important. Let us see if it can sustain the previous sales growth or not. Last 3 years, the compounded profit growth has been a phenomenal 215%. And last 12 months, despite 9% sales growth, TTM is trailing 12 months, the previous 12 months. 49% profit growth despite only a 9% sales growth last 12 months. Then the cash flows of the company, pretty interesting cash flows. Pay attention to cash from operating activity. In 2022, it was 4 crores. In 2023, it was a minus 7 crores. Sorry, minus 4 crores, minus 7 CR. Then in 2024, it recovered to 7 CR, and in 2025, 54 CR. So last 2 years, positive cash flows. Now, what does the company actually do? So, manufacturing solar panels, solar farms, that is its product. But the main thing it does is end-to-end solar and storage solutions, particularly this CAPEX model. We will discuss this a bit later. Right now, look at this. The company has completed around 46 projects. The total capacity of these projects were 253.67 megawatts in terms of AC, which is 336.17 megawatts in terms of DC. In its total history, it has completed these many megawatts worth of projects. Focus on AC right now, 253 megawatts. Currently, the projects that it's currently executing are 765 megawatts for AC. So its total history, how much money it has made, accumulated, it is done for 253 megawatts, but currently it is executing 765 megawatts. Moreover, now what is this? What is this thing? This is for EPC, engineering, procurement, and construction. Basically, a solar farm. It will engineer, it will design a solar farm, it will procure the material for the solar farm, and it will construct the solar farm, and it will give it to the client. So we're not talking about just a solar panel manufacturing company. Its main aim is always its main aim is being an EPC company, mainly installing those solar farms for clients. That's the main aim for the company. So this capacity was for EPC projects. Moreover, it has 325 megawatts of BESS projects right now going. BESS, battery energy storage systems. It's a new business and a high growth business. So this new business capacity plus massive growth in its old business, which was the EPC. This capex model discussed earlier, that is EPC. All right. Then let's move onwards. Robust order book and growth visibility. What is an order book? The orders it's already gotten from customers. Remember, we saw revenues of around 540 something CR for fiscal year 2025. Look at the massive order book. It's in millions of rupees. So 25,278.14 million rupees is its order book standing as of 31st July 2025, which translates to 2,500, 2,527 crores is the total orders it has gotten from its customers. Five times, basically five times the fiscal year 2025's revenue. Massive, massive growth from 1,700 crores in fiscal 2025. In 2024, it was, how much was it? It's 813 crores. So massive growth in order book, and its order book is way more than its revenue, like five times. And the order book is expected to be executed over 12 to 18 months. So you can divide and see how much revenue can actually be achieved by the company and the massive revenue growth that can be achieved by the company. Then look at this. Quarter one fiscal year 2026 business updates. There are a few updates. One, the company has commissioned, that is, has started, it's now operational, a 1.2 gigawatt solar modules manufacturing line. So it has now commissioned its own solar panel manufacturing plant, which will manufacture solar panels for its own EPC services. So it's the backward integration. This will mean backward integration. Then, for its best line, battery energy storage system, a new business, a 3.4 gigawatt lithium ion cell to battery pack has been procured and the site is ready for installation. Equipment deliveries are expected to be completed by end of November 2025 and commissioning is targeted by January 2026. So basically, they're going to be importing lithium ion cells from China and they're going to be assembling them into battery energy storage systems and selling them as this major battery energy storage system to clients. So that is for BESS. Again, for their EPC services, BESS will be a value added service, an additional service in the EPC services. Okay, then junction box manufacturing, 5 gigawatt line is being established. Again, this is also for their EPC services. They're trying to add on to the EPC services. The main aim is to be an EPC company and solar cell manufacturing of solar cells. It's also getting into manufacturing of solar cells. A 1.2 gigawatt facility is projected to become operational between December 2026 and March 2027. Backward integration, all of these things are backward integration for their EPC services. That is the main thing. All right. And it will improve margins because, yeah, they're backward integrating. They're not actually acquiring, like, they're not acquiring solar cells, they're not acquiring solar panels from other companies now who will obviously have their own profit margins. It's going to make them on their own. And if successful execution happens, better margins because they will absorb the previous company's margins. Then, industry tailwinds. How will growth actually be achieved? Now, look at this. As of fiscal year 2025, India has a total cumulative solar capacity of 105.65 gigawatts. Okay, you can see massive growth has been achieved in the previous decade. So 105.65 gigawatts is of as of fiscal year 25, and the government of India has set a target. Okay, brace yourselves, of 280 gigawatts of solar capacity by 2030. It's more than double in the next 5 years, target by government of India, and it's spending massive amounts of money in order to achieve this. So still a lot of growth seems to be there. Then being more specific about the growth of the market, look at this. This is a projection. Again, this is a projection. The third party solar EPC market in India. Basically, like installing of solar farms, installing of solar panels on companies for companies by third parties. The market which Solar World Energy is. It's expected to grow at 11.12% CAGR from 2024 all the way to 2039. 2039 from it's in billions of rupees, so 365 billion rupees in fiscal year 2024, 11.12% CAGR, which is a nice CAGR, growing till fiscal year 2039 estimation to 875 to 900 billion rupees. Then even more impressively, you see this 32%, what is it for? The demand for third party operation and maintenance services for these solar panels. Remember, most of these EPC projects that Solar World Energy Solutions have, it has a clause in it for operation and maintenance services. Solar World will provide the EPC services, that is, it will make the solar panels, it will install it for them, install it for the client, and then provide them operation and maintenance. And these operation and maintenance services are higher margin, they're more profitable, they're a value added service for the company. So this third party OMN services, the demand for them is expected to grow massively from around, these are in billions of rupees, right? Yeah, billions of rupees from 7 billion rupees in fiscal year 2025, growing at a phenomenal 32% CAGR till 2030, 28 billion rupees. Again, these are projections, but the projections makes it seem like all projections point to a fast growing market, which is nice. Then finally, more about the growth. More about the growth. So this has been said. This is a statement said by Mr. Karthik Teltia. I don't know his exact association with the company, but he's an important part of the company's management. The C-suite. The company is targeting 60% of the order book for the current financial year. Current financial year is fiscal year 26. It's targeting 60% of the 2,500 crore order book. So it's targeting a revenue close to 1,500 crores. So more than 1,200 crores. Absolutely. More than 1,250 crores. So from current revenues of 540 crores, it's targeting revenues of more than 1,200 crores. Fiscal year 2026. Then, 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 yes. This again has been said by Mr. Karthik Eltia. So, in terms of vision, firstly, to answer, we intend to be among the top two or three EPC companies in India. That is our vision. We are not transforming into a manufacturing company. Our vision is to remain EPC. All right. So, that was it. Actually, that was the entire analysis. So, what can we say about the company? Trying to grow extremely fast, and it already has order books, orders from customers, which is like 5 times revenue. So, it has for now, big order, big revenue, future revenue visibility, we can say. A nice return on equity, nice return on capital employed, price to earnings, I don't know. Is it a buy or a sell? I can't recommend. But overall, one more thing we can show is this. In the profit and loss segment, pay attention to interest, the interest it pays on loans. Operating profit divided by interest is the interest coverage ratio. If it's less than 1, that is concerning because it means the company will face difficulty in paying off its debt, especially its interest payments. And if it defaults on interest payment, that's not good at all. So in fiscal year 2022, we see 2 crores of operating profit, but 4 crores of interest. That is concerning. That is concerning. That's a zero point 0.5 interest coverage ratio. However, if we move forward, we see 107 crores of operating profit for fiscal year 2025, and for same year we see 6 crores of interest paid. So you can see, like debt wise, the company has actually not taken that much of debt, and interest costs have remained low. Like this is an interest coverage ratio of more than 10, which is very healthy, very, very healthy. Interest coverage ratio more than 10 is very, very healthy. The company seems to be paying its taxes. It has turned cash flow positive. And one more thing I had to mention, yes, for its best project, right? The best project that it had, the battery energy storage system, which is again, a high growing, fast growing segment. Its financing, like its overall capital expenditure has been financed through equity. So it has already been financed and not debt has not been taken to finance it. Second, for its solar cell manufacturing, which is again backward integration, the total capital expenditure is around 520 crores, a little more than 520 crores, and I think 570 crores, something around that range. And 400 and something ish crores has already been financed through equity. So recently it had its IPO, and the money it got from its IPO, right? Around 420 crores of that IPO funds has been used to fund the solar cell manufacturing facility, and they need to take around 150 crores of debt. So that will be the new debt they will be taking. And finally, is there anything to say? No, that is it. That is all I need to say. So bye.